It's midnight. You're wide awake. Your eyes are dry from the blue light, and your thumb is doing that automatic little flick. Scroll, 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 like you're not even choosing it anymore. Zillow, Realtor, Redfin. Same ritual, different night. This isn't excitement scrolling. This is stress scrolling. This is what happens when your brain is tired, but your anxiety still has energy. And then you see it. A starter home. 3 bedrooms, maybe. About 1,200 square feet, a yard the size of a beach towel, laminate countertops that look like they survived 3 different trends, carpet that's beige but in a way that feels emotionally expensive. You can already imagine the smell of that carpet. You can already feel the "we'll replace it someday" lie forming in your head. And then your brain finally catches the number. $500,000. And the listing calls it perfect for first-time buyers. Perfect. According to who? And you do what every normal person does. You try to run the math against your real life. Your paycheck, your grocery bill, your student loans, the fact that your car makes that noise when you turn left. You start subtracting in your head. Not luxuries, necessities. And you start wondering, did I miss a whole level of adulthood? Did everyone else get a secret raise? Or did the housing market just decide we're all going to pretend this is normal now? Here's the honest answer. It's not you. It's the math. And math doesn't care how hard you work. It doesn't care how responsible you are. It only cares about cash flow. And the math is brutal. Today, we're going to walk through the brutal math of the $500,000 starter home in 2026. The full cost, not the Instagram version. Not the version with perfect lighting, neutral throw pillows, and captions about manifesting. The version that hits your checking account every single month. And if you're already house poor, or you feel like you're failing at homeownership, I want you to hear this clearly. This is not a moral issue. It's a cash flow issue. And cash flow problems don't mean you are bad. They mean the system is tight. And by the end, you're going to have something most people never get. Permission to choose freedom over the fantasy. Before we start, drop a comment. What does a starter home cost in your zip code? And if you're comfortable, how many square feet and what year it was built?
The most disorienting part of this conversation is that $500,000 used to mean something. It used to mean you had arrived. It used to mean upgrades were choices, not coping mechanisms. It used to mean big, upgraded, nice neighborhood. In a lot of places now, it means basic. It means entry fee. Not dream home, not forever home, just access. In dozens of major markets, or even within commuting distance of major markets, $500K is no longer a flex. It's the baseline. Baseline doesn't feel aspirational. Baseline feels like pressure. That includes places like Denver and Austin, where median listing prices hover in the "this is fine" zone while regular people quietly panic. And here's the part that turns this from expensive into structurally broken. The median household income in the U.S. is around $84,000, and the market is effectively asking that household to buy a $500,000 home. That's not ambition. That's a mismatch. That's roughly a 6x home-to-income ratio, which is historically unstable for normal families. This isn't about being cautious. It's about gravity. For previous generations, the typical range was more like 2x to 3x income. That difference is everything. But today, 6x isn't a stretch goal. It's a daily stress subscription. It's the background hum of anxiety you can't mute. The feeling that one wrong move could knock everything over. And that brings us to the next layer of pain. Because even if you can technically buy the house, the system has a way of charging you extra for not already being wealthy. When people talk about affording a home, they usually talk about principal and interest like that's the whole story. It's not. It's the beginning of the story. It's the headline number, not the fine print. Let's build the real monthly cost stack for a $500,000 home, assuming you put 10% down, $50,000, because most people do not have $100,000 lying around. That $50,000 alone already represents years of discipline, delayed gratification, and saying no to things other people didn't have to say no to. Step-by-step monthly reality. 1. Principal plus interest, about $2,850 per month. 2. Property taxes, about $500 per month. And that's conservative. Many places are higher. Homeowners insurance, about $300 a month, and it's rising fast. Now, why is insurance blowing up? Because risk has changed, and insurers price risk ruthlessly, because climate and catastrophe risk is reshaping underwriting. 4. Maintenance, the 1% rule, $417 per month. That's $5,000 a year set aside because roofs leak and HVAC systems die. Maintenance isn't optional, it's just unpredictable. 5. PMI, the poverty tax, $200 to $400 per month, often around $300 in the example. This is the part that feels personal, even though it's structural. You pay extra because you couldn't already be rich, and it protects the lender, not you.
That sentence alone explains a lot of modern frustration. When you add it all up, the total monthly cost is $4,367 per month. Let that number sit. That number, $4,367, is the point. That's the starter home reality. And if you're thinking, wait, I've seen calculators online show less than that. Yes, because calculators often underemphasize maintenance, or assume low insurance, or skip the reality of surprise costs. Surprises aren't rare. They're guaranteed, just poorly timed. So no, you're not bad with money if this feels impossible. This is an environment where the baseline costs are climbing underneath you.
Now let's talk about the people everyone assumes are fine. Meet the Johnsons. You probably know them. You might be them. 2 working professionals, combined income $160,000 a year. Solidly upper middle class. The kind of income that, in another era, meant comfortable, breathing room, a little joy. They buy the $500,000 home. They qualify. The bank says yes. Approval feels like validation. After taxes and a modest retirement contribution, they bring home around $9,500 per month. Then the housing cost hits, $4,367 per month. That means nearly half of their take-home pay is gone before life even starts. Before groceries, before kids, before emergencies. And what's left has to cover car costs, student loans, health insurance, groceries, utilities, kids, emergencies. This is where the emotional truth shows up. It's not the big expenses that break you first. It's the small ones. It's the $35 field trip fee that triggers a stress response because the checking account is too tight. It's the $1,000 deductible that has to go on a credit card because there's no margin. It's lying awake at 2 a.m. hoping the HVAC doesn't fail, because a $5,000 repair isn't annoying, it's a financial event. That's not weakness, that's math plus fear. If this is you, I want to say something you might not hear enough. Financial anxiety is not a character flaw. Sometimes it's just what happens when the math is designed to leave you no oxygen.
There's a phrase you need to tattoo on your brain if you're home shopping in 2026. Bank approval is not the same as financial safety. They sound similar. They are not. Let's talk rules.
Financial advisors often reference the 28% rule. Housing costs should be about 28% of gross income. But lenders can approve people at much higher debt burdens because that's how the system moves deals through. Approval is a business decision. Safety is a life decision. And that's why this gets dangerous, because approval can mean you're entering a life where one setback becomes a spiral. Now let's add one more layer people don't emotionally feel until they've owned the home for a year. Amortization. You pay a lot and build less equity than you think. Early payments don't work in your favor. They work in the bank's favor. That matters because people tell themselves, at least I'm building equity. But early on, the equity story moves slower than the cash leaving your account story. So when someone says homeownership is always wealth building, the honest response is, sometimes it is. Sometimes it's just expensive stability. And sometimes it's financial fragility dressed up as success.
Here's the radical truth, especially if you grew up believing renting meant you lost. You are allowed to walk away. Walking away is not quitting. Sometimes it's choosing air. Not because you're lazy, not because you don't want it enough, but because you did the math and you chose your life. Renting can be a strategy, especially when the alternative is being trapped in a payment so large it takes your breath every month. Peace has value. Margin has value. So here's the reframe. Wealth is freedom, not equity you can't access. Wealth is margin. Wealth is being able to handle a surprise without panic. Wealth is being able to say no to a situation that makes you feel trapped. And if you're sitting there thinking, but I'm behind, I want to give you one final line to hold on to. You are not failing. The system is failing you. Tell me what a starter home looks like in your zip code. Price, size, and one detail that made you laugh, cry. And if you're house poor right now, you're not alone. Prioritize your mental health over a system that confuses debt with success.